Is it a good idea for companies to potentially go from reporting 4 times a year to only twice? Let's debate it with 2 CNBC contributors. Bill George is former Medtronic CEO. He agrees with President Trump.
Not always.
Not often.
Not always.
And Bill Cohan is author of Why Wall Street Matters. He disagrees. Bill. Why do you want investors to have less information? Former CEO of Medtronic.
I don't think investors are going to have less information. I think they're going to shift the focus to long-term information. Yes, I agree with President Trump, and I think good for Andrew Newey for proposing it. And all the CEOs I know think that this would shift the focus away from the endless focus on quarterly expectations. And there are a lot of perturbations in a quarter. Like my former company, Medtronic, had a hurricane in Puerto Rico, and the stock goes way down. Well, stock's way up now because of a short-term thing. I think investors get misled.
Do you think that your stock would not have gone down in the middle of that hurricane? It probably you probably would have had to tell the market that there was an effect, right?
Yeah.
And therefore
they pre-announced.
Right.
They pre-announced an effect, and it hit. Honestly, I think it's going to put a greater focus on semi-annual. Look at Unilever. Unilever, Paul Polman, 8 years ago went to, and of course, this is a British company, and they went to semi-annual earnings. They do report revenues at the quarter mark, and I think you can update on strategic matters, and you update on investments and what's happening. I don't think it means less transparency. I think it shifts the focus of transparency to the longer term. And I think this is good for companies. I think, like President Trump says, it will encourage more growth and more focus on growth, and not just this incessant focus on whatever the analysts' expectations are, whether the companies hit them, and the kind of game plan.
Okay, we got to get in Bill Cohan here as well.
Yeah, William Cohan, why is this a bad idea?
Well, I agree completely with Bob Pisani. I mean, if it ain't broke, don't fix it. How can it possibly be a bad thing for investors, retail investors especially, to have more information about a company on a quarterly basis? I just don't see how that can be a bad thing. And beyond that, last time I checked, the president was tweeting about how this is the greatest economy ever. Profits have never been higher. The stock market's never been higher. Corporate profits have been higher. I don't understand it. The unemployment is low. So everything's going great, and now we need to make it even better by not having less information for public shareholders. I completely disagree with this. This is not a good idea. It's not in the best interest of shareholders, especially retail shareholders, who, by the way, own these companies, not the Wall Street firms and not the corporations themselves. So more information is better. If it ain't broke, don't fix it. Please, it's ridiculous.
Bill George, my friend, I'm going to play devil's advocate for a moment and push back a little bit here. Can you point to a way that Medtronic was hurt by you having to come out every 3 months with earnings?
Well, back when I was CEO, which is 15 years ago, I think it shifted the focus too much on the short term. Frankly, we ignored a lot of that focus in those days.
Medtronic?
Yeah, I mean, did you forego investment?
It would have hurt. It would have hurt if I'd listened to them. We didn't listen to them. We ignored it, and we focused on long term. We invested heavily in R&D. We invested heavily in capital equipment. We invested heavily in expanding overseas. It all paid off. We ignored it.
Did your stock
but I was
suffer
arguing
as a result?
back then that we should move away from it. Go ahead.
Did your stock suffer as a result?
Well, no, it skyrocketed because we ignored them. And I've been advocating CEOs do this, but it's hard to do because today we don't focus on how companies are growing and what their results are. We're focused on the expectation. Did you make your number? Oh, it's down 5%. Oh, you said you're going to be down 7%. So this is good. No, I think it's the wrong focus, and I don't think it means less transparency.
I just don't understand what you said. You had a spine. Other CEOs, they should have a spine. William Cohan, you know what we're hearing from these other...
The pressure on boards is great.
William Cohan. So one of we're conflating two things here, right? What I hear often about the quarterly reporting isn't the quarterliness of it. It's that there's so much more legality, regulatory, all the other stuff that goes along with the quarterly reporting that has made it very onerous and costly. Is it possible that there's a middle ground here? Yes, you report quarterly, but all the other stuff can be rolled back.
I think that's what Jamie Dimon and Warren Buffett sound like they're thinking about, a middle ground. Let's focus on the actual quarterly earnings EPS number. I mean, we're talking about a 10Q, which has a lot of information in it that is very valuable to investors, versus this sort of endless focus on making the quarterly number. By the way, it's much better now. In other words, there's much less focus on making the quarterly EPS number nowadays than there was 10 years ago or 15 years ago during the dot-com bubble, when if you didn't make it, your stock tumbled, and if you did, the stock kept going up. I mean, there are some CEOs like Jeff Bezos and maybe like Bill George who are able to educate their shareholders. Obviously Jeff Bezos has educated his shareholders not to be so concerned about quarterly profits, and now he's the world's richest man by a factor of $50 billion. So it can work. Just be a bold CEO like Bill George and Jeff Bezos.
Very quickly,
and
Bill
give
George.
investors more money, more information.
You,
yeah, Bill George, very quickly before we go, isn't it theoretically possible, given technology today, that any CFO would know at any given moment what their earnings are?
Well, Cisco used to say that.
Right.
I think there are a lot of quarterly adjustments. No, I don't agree, but I don't think it's just be on earnings. I think it should be on revenues and market share, employee engagement. Those are leading edge indicators. These are lagging indicators. We need to give them. We need to give our shareholders, all of them, more information on this. And I do think it's Wall Street that's focusing on the short term more than the retail investor. I think they're focused on the long term. I think President Trump is right. We've got to invest more for the long term. If we made this move, I think it would put greater emphasis. It would shift that whole emphasis to greater investments in the U.S. economy, in research, in capital equipment. This is a good thing for all companies and all investors.